another week of wild swings for the stock market. Is volatility the new normal for investors? Joining us right now to talk about that and a lot more is Keith Banks. He is the Bank of America Vice Chairman of Global Wealth and Investment. Keith, it's good to see you.
Great to be here, Maria.
Thank you so much for joining us. Another wild week. Is that true, that volatility is here to stay?
I think it is.
Get used to it.
It's a new world, right? In our minds, Maria, we've had a regime shift. We've gone from this period of secular stagnation to a tactical reflation period. And with that comes more volatility, comes somewhat higher rates, and comes somewhat higher inflation.
Yeah, so what do you do then? I mean, do you worry about inflation right now? Are you worried about higher interest rates? Because when I look at the 10-year at 2.9%, under 3%, I'm thinking we've had rock bottom rates for so long.
Right.
Why am I so worried about 3%?
Yeah, the reality is we got to remember to look at real rates. So even though the entire yield curve has shifted up, real rates are still relatively low, and at the short end of the curve, they're negative. So, you've got to keep an eye on rates. We think this year rates will the 10-year will end somewhere between 3 and 3.25. If that's the outcome, I think that's just fine for the markets.
It's just fine for the markets, and yet we see these volatile 1,000-point moves every time the yield moves up a bit, whether it's long rates or even the 10-year. How do you want to be positioned right now? Are valuations where you think they should be, or do you think we're going to see a further decline?
No, I think what we're going to have is actually, we peaked out probably with multiples near 19 times, just shy of that, at the end of January of this year. Right now, I think we bottomed close to 17 times when we hit an intraday low in early February. We think as the year goes on, rates will expand, PE multiples will expand further. And then you have tremendous earnings growth this year. So this year, we think earnings growth will be between 16 and 20%.
That is a big number.
It's a huge number. And so the combination of those two, in our minds, will get the S&P when we exit this year between 2,900 and 3,000. But it's not going to be a straight line. It's not even clear we have found the bottom. You typically don't find a bottom after the correction we've seen in 1 week. And we think you could see a sawtooth type of action, and we'll ultimately find the bottom and then begin a movement back up again.
You have to be happy with the policies out of Washington and the impact on earnings. I mean, you're talking about 20% earnings for the S&P 500 in 2018.
Absolutely.
Revenue growth of 8% or so, 7%.
Yep.
Where do you want to invest based on those numbers?
So we think, what's been interesting is with this regime shift that we've seen, we saw this instantaneous, we're positioned for yesterday, not tomorrow. Everybody moved to a higher vol, higher inflation, higher rate, less accommodative Fed environment. And that was the big shift that we saw. Going forward, number one, you want to be more cyclical, late cycle, and we're in the late stages of the economic cycle. Cyclical does better, so we think that's part of it. But we think, number one, you still want to be overweight equities. We actually like the developed markets and emerging markets better than the U.S., although we like the U.S., so stay overweighted equities.
Developed meaning Europe and Japan?
Europe and Japan. Okay. But we think the emerging markets, as they're continuing to do this year, will probably do better overall. We like, from a sector standpoint, we like financials, we like technology. One of the things that we think is going to help drive the economy right now is we're starting to see a capital spending cycle finally emerge.
Now, we heard from Kevin Hassett, the White House chairman of the Council of Economic Advisors. He addressed growth as well as inflation this past week. Here's what he said.
Our view is that most of our policies are going to create growth for the economy on the supply side, and that when the supply side growth comes, then that's actually good for inflation, because if you increase supply, it puts downward pressure on prices.
So he's not worried about inflation, and yet this market seems to think inflation is about to get out of control. You don't think so?
No, we don't think so. Look, right now we think some inflation is good. We haven't had that. One of the reasons why companies have struggled with top-line growth is because there's been no inflation. There's been no ability to raise prices. Inflation is going higher because economic growth is higher, both in the U.S. as well as globally. That's a good thing. And if that's the driver of inflation, then I'm very comfortable with that. We're very comfortable. And we think inflation stays relatively controlled here.
All right, we will leave it there. Keith, great advice as always from you.
Always good to be here.
Thank you so much. Keith Banks joining us there.